with another interesting episode on managerial finance. We met you about a few months back on a different model, and we have come together with all my friends here to talk about a very interesting topic which may attract your interest. So I'm Bandula from the Oman PIM MBA batch.
I'm Shanaka Dialvis.
I'm Lalitha Fernando.
I'm Saman Sudhir.
I'm Chaturadik Kumura.
So we formed the group 1 of the Oman PIM MBA batch of 2017. As I said, we are going to talk to you about a very interesting topic today. So we have picked 4 5-star hotels for evaluation. Mainly Taj Samudra, that is our key hotel, that is the main hotel that will be evaluating the financial and non-financial performance. And there are 3 other hotels that we have picked up to benchmark the performance against our main hotel. So with that, we have evaluated, or we have looked into the main shareholdings of Taj. Now basically, almost 83% of the shares of the Taj Hotel is owned by 2 companies. One is Taj Hotels and Resorts Limited. This is a Hong Kong based company, and the other one is an Indian hotel company. So these 2 jointly holds around 83% of the shares, which is a significant amount.
Yeah.
So basically the total control of the hotel is on these two companies. So with that brief introduction, we'll be now moving into the financial performance of Taj, followed by the non-financial performance of Taj and the other 3 hotels. I want to mention something. The 3 other hotels that we have picked up for this evaluation is Galadari, Hilton and Kingsbury, which are once again 5-star properties located in the heart of Colombo. And I think these 4 hotels are really into tough competition to capture the market share. So Shanaka, I would now invite you to take us to the first few financial performance ratios.
Yes. Thank you, Bandul. So let's now dive into the financial analysis of these hotels, mainly the main hotel, the Taj Hotel, and we will do a horizontal analysis of Taj Hotel. That is analysis of how Taj has performed over the years, and then we will do a comparison of Taj with the other hotels. So we will do these 2 together. So along with the analysis of the horizontal analysis, we will do the comparison as well as we go along. So let's look at the most important, one of the most important areas, which is the revenue. So if you look at revenue, now if you look at from 2012 to 2013 in the in the graph, in blue color you see the revenue figures of Taj Samudra Hotel and the other hotels as well. So you see that there's a trend of increase from 2012 to 2013, and there's a sudden drop in 2014. There's a drop of 33.4% of revenue in 2014. And then again, Taj has again increased its revenue year on year, 34.8 into 2015 and 34.4 in 2016. So they have dropped in 2014 and then again increased their revenue steadily over the years up to 2016. So we expect that it is a ongoing trend, so it will increase further. So it's important to see why the revenue has dropped in 2014, because they initially had a good trend, increasing trend, but suddenly dropped in 2014. So when we dived into the financial reports of Taj Samudra, what we saw is that they have done a big investment. They have done a huge infrastructure development project in 2014 during that time where they have to spend a lot of money, but they have strategically done that in the right time, because they have invested that amount so that they upgrade the facilities so that they can catch the market which was growing at that time. So that is the main reason the revenue dropped. Because of the infrastructure development, they had to close down partially the hotel. Yeah. So their revenue dropped considerably. So their revenue drop is shown in this figure. So let's now look at the total expenses that they have incurred Now, if you look at the total expenses they have incurred, that again has increased. There's a from 2012 up to 2016, there's a increase. But if you consider the first 2 years, that is 2012 to 2013 and 2013 to 2014, there's a 12.9% and a 6.2% increase. Whereas from 2015 and 2016, there's a 21.7 and a 24.7 increase, which is quite considerably high compared to the previous 2 years. So it's interesting to see why they have their total expenses increased during these 2 years. So if you again go into the financial details of this company, then we see that the interest expense on bank borrowings has been 55 million in 2014 to 15, and the exchange rate loss has been 35 million. But in 2015 and 16, we see a drastic change. It has reversed. The exchange rate loss has gone up to 190 million, and the interest expense has gone down little by little to 33 million. So there's a big change here in the exchange loss.
So what could be the reason behind this the drastic?
If I can answer that question, Shanika, actually what you highlighted was very interesting. If you look at these figures from 2015 to 16, there's a massive increase in expenses, which normally a company wouldn't expect to happen. And also if you look at the composition, as you very rightly explained, the interest expense and the exchange loss has taken a turn of the 2 years. Now if you take the total 2 years, the total exchange loss alone is around 225 million. It's massive. 225 million for 2 years exchange loss is a massive figure, which will definitely impact the bottom line of any company. Okay. So it is interesting to see, as someone said, as to why the company has incurred its loss. Now when we reviewed the financials, Shanaka, one thing that we observed, that during the year 2014, the company has obtained a loan, a dollar loan actually, to upgrade the infrastructure of the hotel. Now, my estimation is this is around 800,000 US dollars, or close to 1.2 to 1.3 billion Sri Lankan rupees, and that level of investment is massive in any organization. You take any industry, it's a massive investment. Now, why they have incurred such a huge exchange loss is because of this. If you look at this graph, it clearly shows you how the dollar has fluctuated from the year 2014 to 2016 and beyond that. Now what you have in figure 2 here is the zoomed increase of the dollar value from the year 2014 to 2014 and beyond that. If you see, at the time of taking the dollar loan, the exchange rate has been at one level. But soon after taking the dollar loan, the dollar value has, the rupee value against the dollar has declined to some extent. Now this is why the company has incurred the exchange loss. Because in theory, when you obtain a dollar loan, you have to service the loan in dollars. So when the dollar exchange rate drops down, you need to use a bigger amount of rupees to convert it to dollars and to pay the loan. Now this difference is introduced to the books of accounts as a unrealized exchange loss. So that is the main reason behind this huge exchange loss the company has incurred during the year 2015 to 2016 and 2014 to 2015. And it's a pretty interesting move that they have taken, Shanab, isn't it?
That is correct. So let's now looking at that. Now let's move on to the net profit after tax of the company. So again, if you see the blue lines, blue bars, that shows Taj performance. So we see again in year 2012 and 2013 there is a slight increase, and then suddenly a drop, a big drop. It has dropped from a 221 million profit onto a 530 million loss. So that is a big gap and a big drop in 2014. And this again is mainly due to the big infrastructure project that they did because of the revenue loss. But they have incurred a big loss here. But the interesting fact is they have made the loss, but then since they made the right decision at that time to upgrade their facility, they have been able to increase that or bridge the gap, and the loss has been reduced year on year. So if you see 2014, 15 and 16, in 2015 they have reduced the loss up to 180 million, then they have further reduced it to 116 million, and the 2016 year is the turning point where they have made a big jump and they have converted the loss into a profit in year 2017. If you look at the 2017 figures, we see they have 103 million profit in that year. So that is a big gap. Again, they have done a huge change from 116 million loss to 103 million profit. So that is, I think, a very good performance there from the Taj.
Shanada, does this financial figures tell us that the decision that the management of Taj has taken in 2014 is really a strategic decision?
Exactly, Bandhu. Exactly, Bandhu, because I think they have done the strategic investment and they have reaped the benefits in the coming years. So we see that they have reaped the benefits between 2015, 2016 and now in 2017 they are reaping the benefits really well because they consolidated the market at that time with that investment.
Yeah, absolutely.
Interesting, Bandula. Apart from that, what Shanaka explained, answer to your question that how this has affected the Taj and the investment as well as the revenue and expenses. Look at the investment in property, plant and equipment. You could see it's a steady increase throughout, except in 2013 to 14. Apart from 2013 till 2013, it was a steady increase. You could see a sudden jump in 2014. It's an increase of 42.7% in investment in property, plant and equipment. So what could be the reason? There must be a reason. Looking at other hotels, they maintain a steady growth, steady investment throughout the property, plant and equipment. Why only Taj is having such a big rise or big jump? Probably they would have had a good plan, strategic plan, long-term strategic plan, and invest heavily on their property as well as plant and equipments in order to cater in the future market, which they were expecting more tourists to come. And looking at the level of tourist arrival in Sri Lanka for the last 5 years, if you look at, there's a clear increase in the tourist arrivals in Sri Lanka. So we believe through the analysis that we have done, Taj has taken a very good decision in 2014 to have to invest such a big amount in plant and equipment. Looking at the other hotels, going forward, in 2015 to 16, you clearly see another hotel coming into the scene where Hilton also is trying to invest heavily on plant and equipment. Probably Taj would have set the trend and Hilton would have taken it up, and they also wanted to cater the market in the future to come with the lot of tourists hoping to arrive in Sri Lanka.
Absolutely, and correct. And it's very interesting. I think the previous slides that we have seen, I think if you compare the previous slides and these all slides talk to each other. Exactly. Now we saw how the expenses went up, we saw how the revenue dropped in the year 2014, and here, as Narendra explained, we see the investment in property, plant and equipment suddenly rising up by 42.7%, and it is a clear indication that the investment or the loan that they have obtained have been invested in property, plant and equipment, which is to upgrade the facility. So I think all these slides talk to each other and is a very clear case where the strategic decision has been taken by the management.
Just one more thing, and that shows where the Taj gains that competitive advantage over others. Even though they spend a lot in 2013-14, gradually they keep on increasing their revenue. You could see in years to come.
Absolutely, absolutely. So I think we have to now move into the next important area.
To measure a company's performance financially, there are quite a lot of ratios, and like about 25 ratios under the categories of profitability, liquidity, asset management, and debt management, and all there are 5-6 categories. So all these fall into these categories, and some of the ratios which is we are not considered in this exercise, like return on investment, expense to sales ratio, quick asset ratio, and inventory turnover ratio, and the dividend related ratios, because none of the hotels that we chosen is paid dividend, because the board of directors not decided not to pay dividends
during that period.
Yeah. So there are 7 ratios that we have not considered, and in the profitability, under the profitability, we have in our presentation we pick 2 ratios. One is operate profit margin ratio, and which is actually represent the return on return as a percentage of the revenue, like operating profit as revenue. And here what we have seen in 2012 and 13, there is a steady incline in the increase in the profit, operating profit, and then due to these expenditures incurred in 2014, it has gone down. 2014-15 it has reduced, and then it started picking in the 2016. So we have seen that they pick up their operating profit, so which in turn gives the margin as a increased steady growth.
So the same trend continues.
Same trend continues. And the other the ratio we have looked at is the we know ROCE, return on capital expenditure. The return, the operating profit, we take it as a percentage against the capital employed, which is basically the debt plus the equity. So here again, because of that expenditure, we have seen the decline, negative. Basically, it's not a operating profit; it's a operating loss actually. So 2015 and 2014 and 15 we had this decrease, and then they start picking in 2016. I think it's a good growth trend. Yeah, and where when we concern as the Taj and the other rest of the hotels, the 3 hotels that we picked is actually doing well in this period. Now I'll hand over to Chatura to discuss the other 2 liquidity ratios.
When we think about current ratio, that current ratio is like benchmarking in the industry as 2 times. That you have to service your current liabilities from your current assets. Yeah, it is normally that industry keep benchmark as 2 times, but Taj was able to keep it at around above 1.5 times. But because of this investment in 2014, it came down. But it is less than 1. At the same time, it is going to recover in 2016, 2017. It is growing up, but it is still keeping below 1%. But at the same time, all other hotels, they are keeping above 1. It is they are maintaining at least 1 time in the trend. But Taj, it is a little bit below, but we have evidence that Taj going to recover it very soon. I think 2017, 2018 they are going to recover. They are going back to their normal trend around 1.5 times, and they can easily meet the 2 times also.
So I think this is the first. I think the first ratio that came across to us, where the other competitors are slightly above TUJ's performance.
Yes,
Isn't it?
Exactly.
Yeah.
Yes.
And also that other one is we consider as a days sales outstanding ratio. When we think about credit sales, now it is trend that everybody using credit cards. That a lot of companies, they are dealing with Taj Hotel. There are a lot of other activities happening in Taj. A lot of seminars, meetings, and things happening. That all corporate customers, they are paying after some time. It is like a credit payments. That credit payments take some time. Normally, industry average around 30 to 45. It is less than 60 days time. Taj was able to maintain that less than 60 days, but because of this 2014, that significant year, they had this renovation and a lot of closures. That partial of the property was closed. That went above 100 days. They were not able to collect their debts within 100 days also. But it is showing in the graph now they are going to recover it. They have come down around 82 days, and it is now in 2016 it is 60 days. It is falling to 60 days, and they are going downwards. I think they can meet that 45 days, 30 to 45 days margin. And it is interesting to see the hotel Kingsbury. They were able to maintain 30 days credit period. Like when you see the graph, they are always around the 30 days track. So that means maybe their credit sales are less, but they were able to collect that credit sale within 30 days time. And it is clearly evident that Taj also going to meet the industry standard. They will surely come down up to 45 days.
Thanks, Aditya. I think yes, if you look at this graph during the year 2016, other than Kingsbury, all other sign almost the same levels.
Yes.
So it's a good sign. So moving on to the next set of ratios, Shanaka.
Yes. Now one of another very important ratios is the debt equity ratio, or what they call the gearing ratio. This is a ratio that investors look at in a company to see how they fare with their debt, whether they are living a lot on others' money or whether they are managing it quite well. So that is an important ratio that people look at. So if you look at the debt equity ratio, or what they call the gearing ratio, what's the gearing level of that company. If you look at Taj's gearing level in 2012 and 2013 have been very good. Like it has been, we can call it a lowly geared company during that time, because the gearing ratio was, as a percentage, was less than 100%. So they were maintaining a very good gearing ratio in 2012 and 2013. But in 2014, again that significant year, starting from that year, they increased their gearing above 100. So at that point, it turned into a highly geared company. But even though they went above 100%, it didn't go like way beyond 100%. Where we can't say that they faced a heavy risk there. But they are a highly geared company after 2014. So 2014. 15 and 16, their gearing increased, and then slightly up to slight increases up to 2016. But now this gearing ratio, we can't look at the gearing ratio
That's
alone.
what I want to interrupt, Shanaka.
Yes.
Is this enough to measure a company with this debt?
No, Saman. I think we always look at the gearing ratio with the interest cover, or what we call the times interest earned. And because that is where we see both of these ratios to see how the risk factor of the company is. So we have to always look at both of these to identify whether there was a considerable risk in that company. Because there could be some companies who has a high gearing ratio, but still they service their debt well. Yeah. So now if we look at Taj's performance, their interest cover in 2012 was quite low at low percentage, but then in 13 they have increased it to 10.0, which is quite a remarkable increase. So they have had a very good interest cover in 2013, and then in 2014, as we have always seen the trend, it has gone down, because in those 2 years, because they made a loss actually. So you can't actually say that they had a ratio, because they didn't have a profit to service their debt. So they were running at a loss. So those 2 years they had a negative impact on the interest cover, and then again, as we have seen right through, they have recovered on it. Now in 2016 they have come back at 2.007. And if you look at the other companies, other hotels, their gearing ratios also have been quite low. So we can't say that any of the companies were highly geared or highly at risk. And the same with the interest cover. Most of the companies maintained considerable interest cover. But now, with regard to Taj, if you look at Taj, the only year that we have seen that their risk levels increased is 2014, because that's the only year that they had a considerable risk.
Yeah. Thanks, Shagada. So I think with that we come to the end of the financial performance review. Now let's move on to the next area, which is the non-financial performance review. Now to start with that, we'll be doing a short analysis on Taj's operation, because we feel that that is one of the key tools that we can use to evaluate the performance, non-financial performance of Taj on an internal and external perspective. So moving on to the next one.
But there were quite a few awards that the Taj had grabbed during last 4 to 5 years. One of the major awards that they won was that Taj became the one of the top 15 best companies where the employees to work with. And then again they won the silver award for the large scale of service sector by Special Dialogue and Workplace Corporation. So those are the critical and the most important awards that they have won during this period.
Thank you, Lalinda. And also, we all know that in today's world, corporate governance and corporate sustainability initiatives is a key dimension to analyze the non-finance performance of a company. So, Lalinda, you would like to take us to a few initiatives?
Yeah, add on to what Bandula said, the CSR projects are key, especially for companies like Taj, where they are mainly into the finance, but they are not only into finance, that they have proven that they are into CSR projects as well, where they have gone into the rural areas of Sri Lanka, where they have distributed food for the needy people, as well as they have conducted training session for the army cadets, and also for the poor people, that they have organize some musical shows, kind of stuff.
The disabled people.
Thank you, Lalinda. So coming on to the last area, now social media in today's world is the way forward. We know every organization tries to capitalize on social media. Chandra would like to take us to...
In today's world, that whoever tourist coming to Sri Lanka or that visiting elsewhere, they are going through the internet and they are going through the reviews, that what is the review this hotel have. In that perspective, Taj Samudra have very good review. It is
fine. I think with that we come to the end of our review on Taj and its competitors on a finance performance perspective and a non-finance perspective. I think overall we clearly see the strategic decisions that Taj management has taken, especially to upgrade the facility in the year 2014, which has resulted in reaping of the benefits from the year 15, 16, 17 onwards. So I think they have set a industry standard, industry example for other competitors to follow. So with that we come to the end. So thank you very much, gentlemen, for your time, and let's meet you again with another episode of